Hi, welcome back to Lipper's Fund Flows Insight Report. I'm Jeff Turnahoy. For the week ended August 5th, 2015, the conventional mutual funds industry saw widespread outflows as investors moved money to the sidelines. Let's take a look at our macro groups and see what happened. Starting off the top, equity fund investors pulled about $2 billion from their accounts. Taxable bond funds also had a rough week, $1.2 billion from them. Municipal debt funds still haven't found the traction they were looking for, almost $300 million pulled out of them. And the obvious recipient of this week's uncertainty was money market funds, over $20 billion put to work there. Well, the week never got off to a good start. We saw 5 straight days of losses on the Dow, so of course there wasn't much momentum for investors to grab onto. There was really not a whole lot of news this week, and on the economic front, we did see an estimate from ADP that suggested payrolls would be quite a bit lower than previous estimates. However, the government numbers came out today on Friday and corrected that. So in fact, employers added 215,000 jobs to the payrolls in July, not the 180,000 that ADP had estimated. So we've seen some consolidation in the market this week. I think investors are just concerned that there's not a whole lot of great news out of the earnings season right now, and this is keeping people on the sidelines. Well, let's dive deeper into equity fund flows. As I said, $2 billion or so was pulled out of them this week. A lot of this, I think, has to do with lower commodity prices. We've seen a lot of gold futures, copper futures, all turning south ever since May with really no bottom in sight. I think investors are concerned that this does not bode well for stocks in the quarters ahead. Without a whole lot of economic growth globally, that may be a rough patch sooner than we think. As I mentioned, the Dow had 5 straight losses this week. That's not going to get people interested in stock funds either. Domestic equity funds had about $2.4 billion pulled for them, while non-domestic equity funds saw about $400 million added to them. So kind of a continuation of the trend we've seen for the past few months anyway. Equity income funds didn't do as well as we might have suspected. Investors were not looking to hide in value names at all. In fact, they kind of pulled out from almost every corner of the market. Large caps themselves had about $1.5 billion pulled for them. Probably the one bright spot out there are Japanese funds. They saw about $384 million in net inflows this week, but that was about it for the good news. Let's turn our attention now to equity ETFs. They again had outflows, much like their mutual fund cousins. About $1.6 billion pulled from them this week. We saw a lot of selling at the core, but not a whole lot of direction when it came to buying this week. So the week's top draw was the Deutsche Hedged EFA, DBEF. It had about $946 million in net inflows. The S&P 500 Growth, IVW, was well behind, about $283 million in net inflows, and the real estate IYR, another iShares product, had inflows of about $213 million. So there you go, between a hedged EFA product, real estate, and S&P 500 Growth, 3 different corners of the allocation spectrum covered by investors this week. It didn't make a whole lot of sense. So really no direction there as far as what investors wanted. It was clear what they did not want, and they did not want the core. They sold the S&P 500, Russell 2000. So it was clear that investors just wanted to get out of equities in general. There was nothing compelling to draw them in. Next group to take a look at is taxable mutual funds. Again, with about $1.2 billion in outflows, they've had a tough time the last few weeks. Treasury yields were either flat to slightly lower this week, depending upon which part of the curve we were looking at. So it looked like people were sort of taking a risk-off attitude. High-yield funds, of course, were the week's biggest loser. They had $407 million in outflows. Actually, loan funds were the week's biggest losers. They had $598 million in outflows. So investors were definitely trying to look ahead and have not found a whole lot of comfort in loans and high yield, 2 of the more credit-challenged areas of the fixed income market. The surprising news this week, and actually the last 2 weeks, was the Bridge Builder Taxable Bond Fund, a product sold by Edward Jones Advisors. It's a proprietary product. You're not going to find that outside of Edward Jones. Over the last 2 weeks, it's taken in about $1 billion in net inflows, even though it's been around for about 2 years now. So there's something going on in Edward Jones where their brokers have decided that they really do want to be in taxable bonds after all. This week, it took in about $400 million in net inflows. So something maybe heard on their squawk box is changing some opinions, and they're playing contrarians with the rest of the market. Well, let's turn our attention now to taxable bond ETFs. Like their mutual fund counterparts, in the aggregate, they did suffer outflows this week, $455 million. Not a whole lot here. We've seen some interesting spots of interest here and there. 3 weeks of positive performance, though, suggests that the Treasury market has had some spotty performance the last few weeks. Not a whole lot to keep ETF investors interested in these products right now. High yield funds, just like the mutual fund side, suffered some of the most significant outflows. About $793 million pulled from them. Well, next group to take a look at, municipal debt funds. They have also had 3 weeks of interesting performance where it's been good, yet we're still seeing outflows. So the last 2 weeks have been outflows for these guys. This week, with almost $300 million pulled from them, what little momentum they seemed to find a few weeks ago has evaporated. Investors are still skeptical about municipal debt funds. High-yield muni debt funds had about $500 million in outflows, but the national munis led the way, $153 million in net outflows. Well, where did all the money go? This week it looks like money market funds were the lone recipient that could claim some inflows. About $20.3 billion, split roughly as retail investors adding about 4 and institutional investors adding about 15.5. So between the two of them, we get about $20 billion in net inflows. Looks like people are just saving their money. This is the rainy day if there was one in any part of the country during this dry dog days of summer. But they're putting money away right now in cash because they just don't find a whole lot of compelling choices out there. So that'll wrap it up for this week's analysis. Join us online anytime at lipperusfundflows.com, or join us here next week where another analyst will take a look at the flows activity between mutual funds and ETFs. Thanks for watching.